Hi, this is Matthew Cratter from Trader University, and today I want to talk about where the stock market is now. I'm getting a lot of questions from you guys about whether the stock market is headed lower, and I do believe it is. I'm going to show you the reasons in this video. So let's first take a look at Netflix. Now, one of the most bearish signals you can get in the stock market is when a market leader, that is a stock that's been performing really well for the last few years, like Netflix, reports really good earnings and yet still has a negative earnings reaction. So a couple days ago, Netflix reported just blowout revenues and earnings, and the stock gapped up 10%, as we can see right here, and then it proceeded to sell off for the next 3 days. So these kind of reactions where people basically have bought the rumor, then sell the news, the stock reacts badly to really good earnings, is a quite negative sign. We had something similar happen yesterday to CLF. They reported quite good earnings, and the stock still finished down 3 or 4%. Now, on top of that, we have deterioration in the indices. So if we look at the S&P 500, SPY, I'm using the ticker, the ETF, you can see that we are trading, the blue line here is the 50-day moving average, the red line is the 200-day moving average. We are trading both below the 50-day moving average and below the 200-day moving average. Now, what I'll be looking for when we'll really know this bear market is getting started is when this 50-day moving average crosses below the 200-day. But what I'm trying to tease out in this video is some sort of advanced signs. And the biggest one is that we've had two closes below the 200-day moving average in the last 2 days. We've had some rallies both yesterday and the day before, Thursday and Friday. The S&P opened up strong and then sold off into the close 2 days in a row. And both days it finished below the 200-day moving average. The same is true for the triple Qs, which are mostly the tech stocks and NASDAQ tech stocks. This is weakening as well, trading below the 50-day moving average, though holding it a little bit stronger than SPY. Now, the weakest index happens to be the Russell 2000, which are the smaller caps. This one you can see we're probably going to get a crossover in the 50-day and 200-day, and we're trading very strongly below the 200-day moving average. Other indicators are all the weakness in the home builders. Now, a lot of this stuff is caused by higher interest rates, what I'm going to be showing you, but let's take a look at the home builder index. This is XHB. You can see this has just gone off a cliff, which means that the market is anticipating a slowdown in new homes and by implication a slowdown in existing home sales and the strength of the housing market. That's gone off a cliff, and along with that, the regional banks, IAT, has gone off a cliff. You can see this is trading near the lows, and we've actually had a crossover. The 50-day moving average is below the 200-day. And just in general, the financials, XLF, are trading quite weakly. We've just trading quite weak, I should say. We've had a crossover here. The 50-day moving average is crossed below, and you can see we're trading near the lows. These are the big banks like Wells Fargo, JP Morgan, etc. In addition, another sort of leading sector has been the semiconductors, and this is often cited as a kind of an economic indicator, SMH. So SMH is extremely weak. You can see we've had a 50-day, 200-day moving average crossover, and we really closed at the lows on Friday. In addition, we had a couple semiconductor makers report earnings last week, and they reported strong earnings, and they had a negative earnings reaction quite in the same way that Netflix and CLF did. So here's Taiwan Semiconductor, TSM, selling off even on good news. And then I think it was Lam Research, which is LRCX, also selling off on good earnings. So to recap, what I would expect is that I think we're going to have another move lower, and we're going to at least test the lows, test the momentum lows that we hit on October 11th, and I wouldn't be surprised if we do get a crossover here. Now, I'm willing to be proven wrong. If we start rallying back up to the highs, obviously this will change. But these things are all kind of lining up and looking quite weak, and it looks like the trade war and the higher interest rates are beginning to really hurt this market. Now, there are a couple places that are holding okay. Marijuana stocks, you can look at MJ as the ETF. Not a great chart, but it's holding. Stocks like Tilray, Wall off the highs, are still holding quite well. Canopy Growth, CGC. So these are holding well even in a down market. Another interesting blue chip that's been holding quite well is Disney. Disney trading at 52-week highs in spite of the market pulling back. So if we do get a market recovery, you'd expect something like Disney to do quite well and to continue higher. Also Wing, which is the ticker for Wingstop, W-I-N-G, also trading near the highs in spite of this weak market. So if you're looking for rocket stocks or sort of momentum stocks, those are looking like the new market leaders. Disney, Wing, possibly the marijuana stocks, though they may be weakening as well. This tape is looking difficult, so if you're not an advanced trader, definitely a good time to be on the sidelines. There's been a lot of volatility, and these have been very difficult markets to trade. If you want to learn more about how to trade the stock market, check out my books on Amazon. There's a link in the description notes below. Just published a new book on millionaire roadmaps, interviews with self-made millionaires. And you might also enjoy the little black book of stock market secrets. This has a lot of sort of stock market lore and the kind that we've been discussing in this video, how to read price action. Thanks a lot for listening. Be sure to subscribe to my channel. Click subscribe if you want to hear more videos like this, and I'll look for you in the next video. Thanks for listening.